Everybody, welcome to today's fundamentals. Hello, Peter.
Hello.
What's happening in the FX market?
Well, we had a US dollar which tended to edge a little bit lower. I would be noting also cable, which edged a little bit high, however, remains unconvincing. Overall, we had a release from Germany yesterday about the IFO indicators. They're a little bit forward looking. They were sending out some mixed signals, and it seems that the outlook for the German economy for the next 6 months seems to be improving. That's a positive. On the flip side, though, the current conditions seem to be slightly deteriorating, which more or less may not be so good for the euro area. I would be noting that we have lots and lots of buzz around the euro as a currency, and we expect euro traders to be quite busy near the end of the week mostly, when we're getting high impact financial releases. Other than that, I would also be noting that we had some comments from BOJ Governor, new BOJ Governor Weda, where he practically stated that the bank is to maintain a very ultra loose monetary policy settings in place for now, and may hike rates in the future should economic circumstances change. Now, the comment as such may not be something which is out of the ordinary, but what is out of the ordinary is that exactly the comment was made by the new BOJ governor. We haven't seen such a comment in a long, long time coming from the BOJ. And I would say that exactly that Mr. Weta expressed this idea, more or less signaled once again that times are changing in BOJ. So, as we had mentioned in earlier meetings and discussions, we expect BOJ to maintain its ultra-loose monetary policy in place. Any future overhaul of its policy should be happening at a later stage.
And how about US stock markets?
US stock markets were also quite quiet for the time being. Very easygoing opening for the week on Monday. I would expect, though, that volatility may start increasing in the coming days. And I'm highlighting this prospect, A, because we have a number of high impact earnings releases, but we have also high impact financial releases. I would expect volatility to start increasing slowly but steadily from today. Most probably we may see market attention turning towards the tech sector. And the main reason would be that we have today the releases of Google, Alphabet, and Microsoft. So earnings reports are starting to shift towards that area. Also, I would be highlighting that tomorrow we get Meta, Facebook, and on Thursday we get Amazon. Mind you that a number of these high-tech companies had proceeded with layoffs early in the quarter, so any economies of scale should start kicking in by now. And that may provide better than expected results in the earnings reports. Should that be the case, we may see market sentiment improving somewhat, while should the actual figures of the earnings reports disappoint the markets, we may see market worries for a possible recession of the US economy intensifying, which in turn could more or less weaken US stock markets in general. Mind you that today we have also a number of other high-profile companies. Say, for example, American Airlines, we have General Motors, McDonald's, 3M, Verizon. I would also be noting General Electric and PepsiCo. A very interesting release, though, which may be keenly watched. I would expect it to be UBS. There was lots and lots of commotion, especially after UBS took over Credit Suisse. So most probably investors will be keeping a close eye over the rates and figures released by the bank.
And how about the gold?
Well, gold benefited from the slight weakening of the US dollar, which we mentioned earlier.
Uh-huh.
I would expect the negative correlation between the two to be maintained. And I would be noting as the next big test for gold traders to be the release of the preliminary US GDP rate. It's for quarter 1. Should the rate show a slowdown of economic growth in the US, we may see the US dollar weakening, which may provide some inflows for the precious metal.
And what's new regarding oil?
We had an interesting development actually about oil. Oil, yesterday we expected it to maintain its downward motion. It didn't. It was actually able to hold the drop yesterday in the American session and during today's Asian session, early European session. It seems that there are expectations for an increased demand from China over the coming days regarding oil, and the main reason why is that practically in the coming weekend in China we have an extended weekend due to the 1st of May holiday, which may more or less allow for some traveling from Chinese citizens, which in turn could turn demand for oil higher. I would be noting that should the higher expectations for demand side of oil be maintained, given also that we have the releases about the US oil market, and should they show a rather tight US oil market, we may see oil's price rising even further.
And so what's on today's calendar?
Well, we have a number of releases. I would be starting with the CBI indicators from the UK. They are for the current month, for April and for quarter 2. I would be highlighting for April the CBI industrial trends. It's the orders. It was deep in the negatives in March at -20. Should the figure drop even lower, that may imply that even more British industrialists more or less expect the orders level to drop even further. So that's a negative for the pound. Other than that, I would be highlighting in the American session the release of the US consumer confidence indicators for the current month. The reading is expected to remain relatively unchanged, which in my opinion is not exactly positive for the USD. I would like to see a more confident average US consumer, which could provide another boost in US retail sales. That does not seem to be happening for now. I would be also noting from the US the new home sales figure. And for oil traders, I would be noting the weekly AP crude oil inventories figure. Now, there was a drawdown of over 2 million barrels last week. Should there be another drawdown, that would imply that practically production was not able to catch up with demand and the US oil market remains tight. Other than that, I would note during tomorrow's Asian session 2 releases. The first would be New Zealand's trade data, with the main focus being on the trade balance. It was a trade deficit in the past month of around 730 million. Should that widen even further, we may see the Kiwi dropping, as that would imply practically that the New Zealand economy suffered from its international trading activities. And most importantly, I would be highlighting from Australia the CPI rates, they're for quarter 1, and practically the rates are expected to slow down from 7.8 to 6.9% year on year. Should that be the case, we may see the Aussie slipping during tomorrow's Asian session, as the slowdown of the CPI rates would practically allow RBA to remain on hold in its next meeting.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So, welcome to the technical analysis part of the presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have WTI's 4 chart. It's actually where we left yesterday. Let's move back to the US dollar index. And this is the US dollar index for chart. All charts to be presented are to be of the same time frame, unless otherwise stated. Now, let's readjust the chart a little bit. Now, what do we note here? The first is that we saw the US dollar index dropping, distancing itself from the 101.55 resistance line, and seems to be stabilizing somewhat. Yet there's still some residue of bearish sentiment as the RSI indicator is at 39. Note how the index corrected a little bit higher after breaking the lower Bollinger boundary. So for the time being, we may see some slight stabilization, but I wouldn't be surprised to see the bearish movement reignited, most probably during the American session, if not a little bit earlier. In that case, should there be a clear-cut bearish sentiment, I wouldn't be surprised to see the US dollar index dropping, breaking the 100.65 support line, and that would practically open the way for the 99.80 support level. I would like to see how far back we would be going. We can see that, okay, the 155 was tested here, and that was for the last time on the 13th of April. But the S2, we have to go all the way back, 12 months back to 21st of April 2022. So we're talking about a new 12-month low. Should the price action be able to clearly break back in the 4 chart, to clearly break the S1, and that may provide some cold feet for the bears. So should the pair remain in a sideways motion, most probably between the 101.55 resistance line and the 100.65 support line, a movement like this, that would allow us to switch our bearish outlook in favor of a sideways motion, while should we see the price action actually finding fresh buying orders along its path, we may see it rising, breaking the 101.55, nothing less for a bullish outlook here. And in that case, we may even see it starting to aim for the 102.45, a level which was tested here and here. Okay, let's move now to Euro USD. Now, there are two interesting elements here. The first element is that the upward movement of the pair was maintained. You can see a strong rise. And during the late Asian and early European session, the euro seems to have subsided, dropped a bit. Let's readjust the chart so we get a clearer view here. I would be noting also, that would be the second element, that the last peak is actually a bit lower than the previous one. And that's an interesting element, as the pair was unable to mark a higher peak above the 1.1075. So there are some signs of stabilization here. I wouldn't be so certain about the possible bullish outlook. For the time being, though, we maintain a bullish outlook, yet I would require the pair to break above the 1.1075 in order for it to be maintained. Should the R1 be broken, the next possible target for the bulls most probably will be the R2 1.1220. Let's drill out to the daily chart and see how far back actually the R2 goes. And we can see that the last time it was met, it was here, and it was on the 1st of March last year. So we're talking about the 13-month, 14 almost month high. That may make it a little bit difficult for the bulls. Back to the forward chart, readjusting the chart. Here you go. On the other hand, given the pair's inability exactly to form a higher peak, and actually quite well respected the first resistance line, the 1.1075, I wouldn't be surprised to see the price action maintaining also a sideways motion. And should that be the case, we may even see the pair consolidating a little bit lower and testing, if not breaking, the upward trend line guiding the pair since the 20th of March. This one. On the other hand, note how the RSI indicator has corrected lower. It has dropped from the highs of 17, it's currently at 63, which remains actually a little bit high. So there is still a residue of bullish sentiment left in the market for the pair. In that case, may push it higher. For a bearish outlook, however improbable that may be, it's still a possibility and it should be covered. In that case, I would expect the price action of EUR/USD to move decisively lower, break the upward trend line we have mentioned, but for a bearish outlook, I would also require the pair to break the S1 1.0925, signaling that the interruption of the upward movement is not a mere sideways motion, but a clear-cut bearish outlook. Such a movement, i.e. lower than the upward trend line and lower than the S1, would actually enable us to start drawing a downward trend line showing the limitations of the downward movement. For the time being though, I wouldn't be surprised to see the bulls maintaining control. Okay, let's move to GBP/USD. GBP/USD is in a clear-cut sideways motion between the 1.2540 and the 1.2350. You can see it by the yellow rectangle exactly highlighting the sideways motion of the pair, and that's since the, let's have a look, 3rd of April. So we're talking about a sideways motion for over 3 weeks now. Should the bulls take over, which is not our case given that we have the Bollinger Bands, which despite despite some widening here, remain rather tight. So that tends to imply low volatility for the pair, which may allow the sideways motion to continue. The RSI indicator has corrected even lower, nearing the reading of 50 from above. So that tends to imply also that the bullish effect, whatever there was, is fading away as well, and would allow us for a sideways motion to be maintained. So all points towards a continuation of the sideways movement bias we currently have. On the other hand, as we have mentioned before, should the bulls take over, I wouldn't be surprised to see the price action rising, breaking the 1.2540. I would require a higher peak than this one. And in that case, we may see the price action aiming for the 1.2770. On the flip side, should the bears take over, we may see the price action of cable dropping, breaking the 1.2350. Mind you that the level was tested once, twice here to the downside and had held. So it's a pretty valid level. And for a bearish outlook, I would require the price action to move below the S1. And should the S1 be broken, the next possible level which could be put to the test would be the 1.2185. Note how the level was tested to the downside here and here, provided some commotion here, and was tested to the upside extensively here. Quite interesting pair. Let's move now to USD/JPY. Okay, USD/JPY, we have to make some slight readjustments here. Definitely on the R1 level. I'm going to be lowering it to meet the peak of the price action here. And that would be the 135.15. Let's change also the label content. So there is a sideways motion. It's a bit higher than the previous one, but nevertheless, let's highlight it. Here we are. Now, should the sideways motion be maintained, I wouldn't be surprised to see the upward trend line being broken and the price action on the other hand though respecting the 133.70 support line. On the other hand, actually before we move to the bullish outlook or the possibility of a bullish outlook, I would be highlighting also that this peak is lower than this one. So that's another indication of a sideways motion, or at least that the bullish movement may be about to be interrupted. Also note how we have an RSI indicator which has dropped below the reading of 50. It's actually still pretty close. It's at 46, remaining rather unconvincing, implying a rather sideways motion, or if you prefer, an indecisive market. Now, the boys at research just told me the following, which I would like to share with you guys. Give me a sec. Let me clear the chart. Let's delete the ellipses and the rectangles. Close. So what do we see here? The boys at research highlighted the possibility that we may be talking about a head and shoulders formation. And that's a possibility. Why? Because you have three peaks which seem to be nearing each other. And it would be like you have one shoulder, a second shoulder, and you have also a peak. Let me color this in red. And that would be the head. So you have a very similar to a head and shoulders formation price action, which should that be the case and should that be actually be head and shoulders, then I wouldn't be surprised to see the price action dropping, breaking the upward trend line, clearly breaking the S133.70 and expected to go all the way lower up until this. So that would imply practically that we may see the price action dropping up to this level. Let me delete this and insert a new shape. Here you go. So practically what we are implying here is the following, or at least the boys at research are following. There seems to be a head and shoulders formation being formed by USD JPY over the past 1 week. And should that be the case, I think that would be more clear to see if we drill to the daily chart. Let's zoom in. Nope. Back to the forward chart, zoom out. And that should be the case. We may see practically the pair dropping quite lower. Readjusting it. There you go. It's going to be interesting to see whether that's going to be followed by the price action. And that would be signaling a clear-cut bearish outlook. Note that the price action is currently putting to the test the upward trend line. And now we have two possible scenarios. Three. Sorry. The first scenario is that this is going to be a false break, in which case I would expect it to bounce higher, rise, possibly break the 135.15 and start aiming for the 137.80. That would be a bullish outlook, given that A, the upward trend line was respected, B, the R1 was broken. The second scenario would be, okay, it may break the upward trend line, but respect the 133.70, bounce on it, and remain between the 135.15 and the 133.70. That would be implying practically a sideways motion. And the last scenario is the bearish one, in which case we may see the price action dropping, breaking the upward trend line, breaking the 133.70, which would have the funds to practically drop all the way down to this level. It's a very, very interesting moment for USD JPY on where it's going to be going. Okay, let's move now to USD CHF. USD CHF, which in contrast to, say, for example, USD JPY, which was also safe haven currency pair, maintains its bearish tendencies. It's very, very obvious. Let me delete this. So we tend to maintain a bearish outlook, which is also being supported practically by three elements. The first and foremost and most obvious of all supporting a bearish outlook is the downward trend line, which has been guiding the pair since around the 8th of March. So we're talking about a downward movement which is over 1.5 months old. The second element I would be highlighting would be the RSI indicator, which is running along the reading of 30, exactly highlighting the bearish sentiment of the market for the pair. And I would be noting that, okay, it may be nearing oversold levels, it may be correcting a little bit higher. But as long as the price action remains below the downward trend line, we maintain our bearish outlook. Mind you that the same signal is being sent also by the price action flirting with the lower Bollinger Band, also implying a bearish sentiment, but within some boundaries here. So we have up until now two elements supporting the idea of a bearish outlook. And the third would be you have the 100 moving average in orange here, the 50 moving average in green here, and the 20 moving average, which is also median of the Bollinger Bands here, all pointing downwards. Exactly highlighting, or if you prefer, underscoring the downward motion of USD Should the bears maintain control as expected, I wouldn't be surprised to see them breaking the 0.8860 and start aiming for the 0.8760. On the other hand, we may see the price action bouncing on the S1 like it held here, and that would cause to a reversal, slow but steady reversal of the downward motion. However, once again, for that to be corrected, I would require a breaking of the downtrend line. For a bullish outlook, it may be seeming a little bit improbable in my opinion as well, but it's still a possibility. And I would require for a bullish outlook the price action to reverse direction, break the R1 0.8935, also break the downward trend line, signaling exactly the interruption of the downward movement, and the price action to start aiming for 0.9020. For the time being, once again, we highlight a bearish outlook, but over the next 24 hours, we highlight the risk of a stabilization, given that we can see the 0.8860 has proven its worth around the midst of April. That was about 1 week ago on the 13th of the month, 10 days. So it's a level to keep an eye out. Let's move now to commodity currency, AUD USD. Let's reposition the labels. So the pair maintains a sideways motion. It's a wide one, but it's still a sideways motion between the 0.6755. Boys in the trading desk more or less tended to gain by selling on the highs and buying on the lows here. For the time being, we tend to maintain our bias for the sideways motion to continue, which may allow AUD USD to near the 0.6625 support line, but most probably remain there and bounce on it, once again starting to aim for the R1 0.6755. It's a very beautiful, very characteristic channel, sideways channel motion with very few interruptions, one here, and one to the downside here. But overall, we have to note that both the R1 0.6755 and the S1 0.6625 held the ground. It's characteristic that the motion seems to be starting from around the 10th of March, so we're talking about 1.5 months old. For a bearish outlook, we would expect the price action to drop, break the 0.6625 support line, and start aiming for 0.6520. On the other hand, for a bullish outlook, I wouldn't be surprised to see that being rather steep and intense, like this one here. However, in this case, I wouldn't be surprised to see the price action rising, breaking the R1 0.6755, and start aiming for 0.6855. Now, for the time being, once again, we maintain our view for a sideways motion between the R1 0.6755 and the S1 0.6625. We're talking here about 130 pips, which would allow for some profitability to emerge should you trade on that level. USD CAD, the second commodity currency pair. Now we have an interesting development here. Okay, the price action seems to maintain its upward motion. That's clear. We have continuous higher truths, higher peaks, and nice clear-cut upward trend line guiding the pair. I think that would be more obvious if we drill into the 1 hour chart. Allow me, please. There you go. Beautiful. Note how the peaks 1, 2, 3, 4, 5 are higher, and we have 1, 2, 3, 4. This one's interesting, but continues. 5. So I think we're talking about a clear-cut upward trend line which has pushed the pair higher to break exactly the 1.3545 resistance line. So that has been to be turned now into support line. That's clear. Locking it in. Let's go hunting for a new ultimate resistance line. You have a peak here, which cannot be neglected. See how there was an upward motion which was practically interrupted at this peak here. Afterwards, we have a downward motion, once again peaking, downward motion again. So practically this level instigated the downward motion, and that would be the, in red, 1.3975. Locking it in, readjusting the chart, pretty wide, but still. Let's reposition the labels. Quite volatile pair here. Starting with the S3, which is now being placed at 1.3270. The S2 at 1.34. The S1 at 1.35 45, the R1 at 1.3645, the R2 at 1.3810, and the R3 at 1.3975. Locking everything in. Okay, let's talk direction here. Definitely a bullish outlook is in place, and that's being supported by the price action being on the rise, supported also by an upward trend line. It has broken the 1.3545 resistance line, now turned to support. So that would be one clear indication for a bullish outlook. The second indication for bullish outlook would be the RSI indicator, which has risen above the reading of 70. It's actually at 71.4. So that tends to imply the bullish sentiment once again of the market. On the other hand, though, may also imply that the pair has reached overbought levels and may be ripe for a correction lower. It seems that the Bollinger Bands are still allowing for some space between the price action and the upper Bollinger Band, which more or less may allow the bulls to still have some room to play here. And the third element supporting an upward motion would be the 20 moving average, which is also the median of the Bollinger Band, has turned now clearly upwards. Also the 50 moving average in green, while the 100 moving average, due to its longer tail, was not able to catch up just yet. But it's still turning. Definitely the downward motion has been interrupted of the 100 moving average. Once again, we maintain a bullish outlook. I would expect the price action to rise and start aiming for the 1.3645 resistance line, this level here. I wouldn't be surprised even to see it breaking the R1. On the other hand, given that the RSI indicator is above the reading of 70, we may see some consolidation. I wouldn't be surprised even to see some correction. And that would provide practically the chance for a sideways movement to emerge, which would be practically implying that the price action has to break the upward trend line. That's the first signal, in my opinion, for an interruption of the upward movement, unless, as a co-worker has noted, we are accepting this as the upward trend line. But it's too close, actually. Nevertheless, I would like to see, let me recolor this. I would like to see the black upward trend line being broken before actually switching my bullish outlook in favor of a sideways movement initially. For a bearish outlook, I would require the pair to drop, break both upward trend lines, break the S1 1.3545, and start aiming for the 1.34. Okay, let's move now to the Kiwi. We're also getting New Zealand's trade data during tomorrow's Asian session. There are two elements which tend to take precedence here. The first is definitely the breaking of the downward trend line. That's clear. And it's clear in the sense that the pair is marking a higher trough. This one. So the downward trend line was broken. The downward motion, even temporarily, has been interrupted by the price action. So that's an indication of a sideways motion. The second indication of a sideways motion is the RSI indicator. The RSI indicator is now running along the reading of 50, exactly implying this indecisiveness in the market about the pair's next leg and its direction. Note also how the price action has practically respected the R1. It was not able to break above it. It even reached it. And that tends to imply that most probably a bullish outlook is not in the cards just yet for the Kiwi. So a sideways motion, possibly below the 0.6190, just below it, would be acceptable norm. Note how the moving averages are slowly turning, exactly reflecting this interruption of the downward motion. Should the bulls take over, I would expect the price action to rise, break the 0.6190, and start aiming for the R2 0.6270. We're talking about 80 pips here. While on the flip side, should the bears regain control, I would require the pair to drop, break the S1 0.6090, which provides support here and here. And that would pave the way practically for the 0.5980. But the pair is already at rather low levels. You can see that the S1 has not been broken with the exception of, actually it wasn't broken even here. The last time it was broken with the daily chart, it was since the 22nd of November last year. So we're talking here about 5 to 6 months. Quite interesting. Back to the 4-hour chart, readjusting it. Sideways motion prevails for the time being. Let's move now to gold's price. Gold's price, which seems to be maintaining a sideways motion around the 1985 support line. It's interesting how the precious metals price is actually revolving around that level. It's like this. It's like the S1, the 1985 level, it's its axis. The RSI indicator seems to be near the reading of 50. It's actually at 47.8, implying also rather indecisive market about gold's direction. So I wouldn't be surprised to see the price action maintaining this level. Should the bulls take over, we may see the price action rising, testing the R1 2031. While should the bears take over, we may see the price action dropping, breaking this 1985. That should be a clear break though, for it to be convincing. And for it to be a clear break, I would require the pair to start aiming, if not even reaching, the S2 1935, a level which provides support here. Now it may sound like a long distance for gold's price. We're talking about $50 drop. Could be done. Could be easily done. You can see how the precious metals price dropped here. And that was a drop of around $50. Let's have a look how wide that was. 58. So that should be it for today. Actually, I see that you have a small request about your stock markets. Let's have a look. Okay, there is a sideways motion here for the Dow Jones index between the 34,160 and the 33,500. Do not be fooled by the sideways motion. It's the market's wait and see position, in my opinion. Okay, on technical basis may be maintainable, but I think that the fundamentals are going to be altering that direction. That should be it for today from all of us here at IronFX. Best wishes for solid trading.
So welcome everyone once again to our webinar today. We will be doing advanced moving average strategies. We're going to go through advanced moving average. You guys already know moving average. This is the most simple form of technical analysis. I personally, when I just started trading, this is the first indicator I've ever learned, and you guys will be surprised. I paid quite a bit to learn this because I signed up for one of those crazy trading courses. Nowadays, things are free. Like you guys join this webinar for free, right? Yes, so back then I had to pay like thousands to learn the moving average. I know how ridiculous that sounds. Okay, let's do the disclaimer first. So just a warning, a reminder that whatever I share in this webinar should not be construed as trading advice. It should only be taken as educational. Okay, this is only an educational webinar. The whole point of this webinars by IronFX is to help you guys grow as traders. Okay, it is to help you guys grow as traders. Right, please don't take it. There's no signals, there's no forecasting here. Okay, if you guys are waiting for the entry, the take profit, the stop loss, you're not gonna find it in this webinar because we can advise you when we think it's a good entry, but ultimately it's your choice. Another reminder, trading Forex and CFDs carries significant risk and may not be suitable for all investors, right? So do be cautious, especially if you are new here. The risk multiplies immediately, especially if you are going on leverage or margin, right? So please do be cautious. For those who are new here, do not jump into the ocean without first learning to swim. Okay, for those who don't already know me, I think I've taken you guys once or twice before, right? For those who don't already know me, my name is Cass. I am an investment analyst and a prop trader here at Everest Fortune Group. So Everest Fortune Group, we're an award-winning research firm based in Singapore. We're a fintech company. Okay, what we do, we heavily research on strategies, back testing, and we advise the banks, brokerages, financial institutions, hedge funds on where we think the markets are going. So we do a lot of research on the characteristics of the market, where it's going, how it reacts, and blah blah. And we try to find strategies to overcome that. And like today, we are going to share the strategy that you can use with moving average. Okay, so Everest Fortune Group, we've won. We're the finalists for the best Forex and best equity research for 2019, 2020, and 2021. Back to me, sorry. I personally am managing quite a, actually it's way more than 300,000 now. Okay, I'm managing quite a bit of funds, way more than 300,000 US dollars on my own personal account. That's me as a trader. I've passed FTMO twice, and I've passed my Forex funds twice. So for those who don't know what these are basically prop trading tests that requires you to have a 10% profit within the month. Okay, so I've done that consistently month after month, and hopefully as I go with you in this webinars, I can show you guys how I managed to do that 10% every month. Okay, cool, everyone, cool for now. Okay, I'm gonna move on. Okay, so our agenda for today will be to understand what moving averages are. Okay, and then we're gonna look at some of the common moving averages out there. We're gonna look at two today, and we're gonna look at the natural moving average. So natural moving average is a kind of strategy, moving average that we use here as Everest Fortune Group. If you Google natural moving average, you won't be able to find a lot of information on it, because why? I think it's kind of a bit like it's something that we invented in a way, the natural moving average. right? So this is because I was saying we spent a lot of time back testing and looking out for strategies and patterns on the chart. So we found that the natural moving average is a strategy that works very well on when it comes to trading. Okay, so just bear with me. We will get to the natural moving average towards the end of the sides or midway of the sides. And lastly, we'll be identifying reversals with the natural moving average. And if we have enough time, right? If we have enough time, we will be moving to trading view so that I can show you guys ultimately live examples of how this will work. Why? Because look, I love doing this webinars for you guys, right? It's a lot of theoretical stuff. It's a lot of textbook stuff. You know what I mean? So I can tell you what the moving average, the definition of the moving average. I can tell you the calculation of the moving average. Blah blah blah. I can tell you so much about the moving average. But ultimately, if you don't know how to apply the moving average, it would still not be useful. You know what I mean? If I give you a pen and you don't even know how to do what to do with the pen, you don't even know how to write, that pen will just be obsolete to you, right? So ultimately, we will try to go to TradingView if we have time to kind of apply the moving average and see how it works. Okay, so before I move on, can you guys just let me know in the chat box if any of you use the moving average to trade? Have you ever heard of it, at least, the moving average? No, no one? Okay, thank you, Lola. No one has ever heard of moving average. It's the most, I try but don't understand. Okay. Yes, we got a lot of yeses. Yes, this is not unusual because, again, I said it's one of the most common indicators. I only look at it at a very basic level. Yes, me, myself, personally, I only use moving average on a very basic level, and I'll show you guys why later on towards the end of the webinar. Okay, so moving average, when I just started using it, I learned it very simple. Okay, if price, let me grab my pen so I can show you. So when I went for these crazy courses where I had to pay so much money to attend, the guy basically taught me that when price crosses above the moving average, you should get in for a buy. Okay, when the price goes below the moving average, you should get in for a sell. Okay, that's what I learned about the moving average. It works sometimes, doesn't work sometimes. Most of the time, it doesn't work that well. Okay, that's why you should never use, although today's topic is moving average, I must say, because like every week we'll go through different topics, right? Sometimes we'll go through moving average, Ichimoku, trend lines, support resistance, whatever it is. You should never use one technical indicator on its own to look for entry, stop loss, and take profit. It should never be only one to look for your analysis. It should always be a combination of all things to look for your analysis. And I want to use this example, which I am sure you guys heard when I took you the last time. It's the same as like you're going to a mall, you're buying a pink dress, okay? You see the pink dress, you don't know if it's good or not. So if enough people tell you that the pink dress is nice, you are going to buy it, right? But if everyone keeps telling you it's a no, you're not going to buy it. So it's the same as like you going to your dad, hey, does this dress look nice on you? And then your dad goes like, yes, it does look nice on you. And your mom says, yes, it looks nice. Your sister says, yes, it looks nice. And your brother says, no, it doesn't look nice. Okay. So similarly, when we're looking for trades and setups, we need different technical analysis to give us data and, well, not opinions, but more like analysis, right, of where those technical analysis think price is going. So if enough technical analysis is telling you that price is going up, you are going to get in for a buy. If enough technical analysis is telling you price is going down, you are going to get in for a sell. Okay, right? So moving average is just a tiny part of your entire analysis. Okay, it is maybe your dad. When you ask your dad, hey, is this dress nice? Moving average will tell you yes or no, it's nice or not. That means moving average will tell you it's a buy or if it's a sell. Okay, support resistance will be your mom. Okay, trend lines will be your brother. Okay, and so on and so forth. Okay, so again, moving average is just a tiny part. So let me explain what moving average is in a very textbook definition. Right, again, I'll go through all the textbook stuff, all the theoretical stuff with you, but ultimately you need to be able to grasp Hey, Fauzan, welcome to the webinar. You need to be able to grasp how to use this indicator, the best way to use this indicator. You can know this in and out, but if you don't know how to apply it, there's no use. Okay, so let's go through the textbook definitions and all, a little basic backstory on the moving average, and then we will try to go into applying it. Okay, so a moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. Okay, it sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. Okay, it is called a moving average because it's a continually recalculating based on the latest price data. Okay, to put that in the most simple terms that I can think of, right? That is the most textbook definition you can think of. Let's say you see all these candlesticks, okay? If you put your moving average settings to 5, it's basically taking the price of the last 5 candles and dividing it by 5. So it's basically the average of the 5 last candles. If you put the settings at 20, it's the average of the last 20 candles. If you put it at 100, it's basically the average of the last 100 candle. That's why you can see most of the time the moving average is there a best moving average? You know, when it comes to technical analysis, I don't think there's ever a best of anything. It's whatever works the best on whichever time frame and whichever charts you are looking at. So I'll give you an example. There are certain pairs, there are certain forex pairs on certain time frames works well on a strategy that we have found here at Everest Fortune Group. It's called the Nike Tick strategy. That's a totally different webinar. Okay, we found that that strategy works very well on gold. Okay, but that same strategy does not work very well on AUD USD, for example. Okay, so there's never a best of something. There's always which works best at that particular time frame and that particular pair and that particular instrument. Okay, that's why backtesting and research. I have to say, I don't think trading is hard. I think it's a very simple thing. You can probably teach it to a 12-year-old and they will be able to get trading. Like, what's so hard? You just buy and you sell, you put a stop loss and you take profit, right? It's not hard. The hard part is the time consuming part is actually backtesting and learning how to trade. That is the time consuming and the hard part, to be able to grasp and be able to collect all this data. Okay, so that I think is the harder part when it comes to trading. Okay, I hope that answers your question. So okay, let me continue with the definition of moving average. So analysts use the moving average to examine support and resistance by evaluating the movement of an asset's price. A moving average reflects the previous price action movement of a security. Analysts and investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator. Yes, moving average is a lagging indicator because it trails the price action of the underlying assets to produce a signal and show the direction of a given trend. Okay, I'll tell you guys, when I started using the moving average, I was not making a lot of money. This was when I just started trading. Okay, why? Because the moving average is a lagging indicator. It gives you information that is slow. Okay, so in the beginning, when I was losing a lot of money in trading, I was thinking to myself, this indicator is so dumb. Why is anyone even using this indicator? You're only right like 4 times out of 10 times or 3 times out of 10 times, whatever it is. And the times that you are right, you don't even make that much. When you lose a lot, okay, whatever it is. I was blaming the indicator. So now that I've learned as I grow as a trader, it's not that the moving average is completely useless. It's just like, maybe right now I find that I really love the Ichimoku cloud indicator, right? So to me, the Ichimoku cloud indicator is a Ferrari, and the moving average may be like a maybe a mom van, for example, maybe a van. Okay, so if you were to race, obviously the Ferrari is going to win, right? But it doesn't mean the van is completely useless. The van is still going to get you from point A to point B. It's just that the van is going to get you from point A to point B. It's more fuel efficient, maybe. It gives you more room. You can fit more people in the van compared to the Ferrari. So every indicator has its pros and cons, okay? So the moving average as well has its pros and cons, even though it is a lagging indicator, and we will look into that, okay? So a moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of times periods. The average moving averages help technical traders to generate trading signals. Okay, again, the general thumb of rule is if price breaks above the moving average, you are bullish. If price breaks below the moving average, you are bearish. But in this case, you can see how it didn't work out here. It wouldn't have worked out here because price was moving sideways. Okay, so that is the definition. The common moving averages out there. Today we are going to look at 3 kinds of moving average. One is, oh sorry, I don't know why I put the weightage moving average in there. We're not going to be looking at weightage. Okay, we're going to be looking at the simple moving average, which is the most common moving average out there, and the exponential moving average. Okay, so this is basically the calculation. When I look at it, I don't like, I know if I refer to my notes or whatever, I know what it means, but just one look, I wouldn't know. And that's totally fine. Again, more importantly is how you apply the indicator. More importantly, you don't know how your clothes are made, right? You don't know how electricity works, right? But you know how to turn on the switch, right? You know how to turn on the switch to use the electricity. So the same, this looks very complicated. More importantly, we need to know how this works, okay? So let's start with the simple moving average. The simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of the time period. So traders use the simple moving average indicator to generate signals on when to enter and exit a market. And SMA is backward looking, and it relies on the past price data for a given period. It can be computed for different types of prices. So for example, you can get it from the high, the low, the open, and the close, okay? In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for securities. The SMA helps to identify support and resistance price to obtain signals on where to enter or exit a trade. When generating the SMA, traders must first calculate this average by adding prices over a given period and dividing the total by the total number of periods. The information is then plotted on a graph. So the formula for simple moving average is written as this was a calculation. Let me go back to the last slide. So yes, this is basically a calculation, okay? It's basically, let's say you choose 5, right? Let's say you choose your period as 5. So let's say the first price was 1, 2, 3, 4, and 5. Okay, you add 1, 2, 3, 4, and 5 together, you will get 15. Okay, and then you take 15 and you divide it by 5, you will get 5. Okay, so that's basically how you calculate the moving average. It's just the average of the period that you chose. Okay, it's as simple. It's basically the name. It's just the average. And why is it called moving average? Because it's literally a moving average. Okay. So A is the average in periods and N is the number of periods. Okay, everyone good? Gonna move on to the exponential moving average. Okay, so the exponential moving average, which gives more weight to the most recent price points to make it more responsive to recent data points. So the exponential moving average is not as lagging compared to the moving average, okay? An exponential moving average tends to be more responsive to recent price changes as compared to the simple moving average, which applies equal weight to all price changes in the given period. When calculating the exponential moving average, the following 3 steps are used. Let me show you the calculation again. This is the one, C minus P times 2 over N plus 1 plus P, okay? Okay, so yeah, 3 steps that I use are, number 1, you calculate the simple moving average for the period. The EMA needs to start somewhere. So the simple moving average is used as the previous period's EMA. It is obtained by taking the sum of the securities closing prices for the period in question and dividing the total number of periods. Okay? It's similar to the simple moving average, but you take the price from the close. Okay. Number 2, you calculate the multiplier for weighting the exponential moving average. So the formula for calculating the multiplier is as follows. Multiplier equals to 2 divided by the selected time period plus 1. So for example, if the time period is in question is 10, the multiplier will be calculated as 2 divided by 10 plus 1. Okay, so the 2 divided by x plus 1 is fixed. I'll just quickly go back. I know this is, so 2 divided by n plus 1. The n is the variable that changes, okay? And then you'll get your answer. So the last step is to calculate the current exponential moving average. The last step calculates the current EMA by taking the period from the initial EMA until the most recent time period using the price multiplier and the previous period's EMA value. It is computed using the following formula. The current EMA equals to, okay, that formula I showed you guys a while ago. Okay, it's basically the calculations. So what is the difference between the EMA and the simple moving average? Okay, the main difference between the two technical indicators is the sensitivity that they place on price changes. So the exponential moving average tends to show more sensitivity to recent price point changes. This makes the EMA more responsive to the latest price changes. The formula for calculating the EMA tends to be complicated, but most charting tools make it easy for traders to follow an EMA, okay? In contrast to the simple moving average, applies equal weighting to all observations in the data set. It is easy to calculate, being obtained by taking the arithmetic mean of prices during the time period in question. Okay, everyone okay with the definition of simple and exponential moving average? Don't worry. Don't worry, when I just learned it, I'm just like, oh, this is so dry. Don't worry, okay. I was there once before. For those who are new here, for those who already learned this, right? For those who already learned this, you're just like, okay, I already know this stuff, right? Then it's how we apply it. Okay, so I'm gonna teach you guys the natural moving average, which is what we use a lot here at Everest Fortune Group, okay? Oh, by the way, if you guys are wondering why I'm from Everest Fortune Group, I probably forgot to mention in the introduction. It's because we have a special collaboration, okay? We have a special collaboration to bring you guys these webinars so that you guys can grow as traders. For those who are already profitable, more information to learn, just a different point of view. For those who are still learning and growing as traders, I'm happy to help you guys be even better, okay? So the natural moving average. When you go on Google, when you look for books on moving average, you always hear people saying, oh, the 100 moving average, the 200 moving average, the 50 moving average, the whatever moving average. My question is, can you guys, for those who use moving average, can you guys let me know what number or what settings for the moving average do you usually use? Is it the 50, the 100, the 200? I see Lola saying that she uses the 10, 60, and 200. Anyone else uses a different number? Okay, so Andrej, I hope I'm pronouncing your name correctly, uses the 50 and 100. We've got Kurt using the 50 and the 200 as well, only because that's what a video said to use. Okay, Kurt, I was using the 50 and 100 as well. It's called the golden cross and the moving average. Okay, right. I was using that as well because, yes, I saw a video that told me to use. Actually, no, it was from that course that I went, the one where I paid few $1,000s to learn about moving average, right? That guy told me to use 200 and 100. I can't remember what it was. Okay, Philip uses the 15, Kingsley uses the 50, the 100 and 200, and Ola uses 7, 14, 89 and 200. Okay, very uncommon numbers. Okay, so as the answers are coming in, I see a lot of people saying 50 and 200. Why? Because this is commonly believed to be the best settings to use. Okay, I'm not saying it's not good settings. It's just that here at Everest Fortune Group, we have noticed that, I mean, think about it. Okay, think about it, right? Let's say you are going to a party, right? The theme of the party is Hollywood theme, right? You have this beautiful, I know I use dresses as a lot of my references. Okay, you have a very beautiful um, you have a very beautiful mini skirt, for example, and very tall stilettos, very tall heels. That short skirt is something you usually use when you go clubbing, right? When you go to the club, you use that very short skirt or whatever it is. But today the theme is Hollywood. Okay, the theme is Hollywood. So you expect really big, gorgeous ball gowns, fancy wavy hair, whatever it is. Okay, the dress will not, the outfit that you choose, which is a short skirt and maybe spaghetti strap, whatever it is, does not fit the theme of Hollywood theme. Okay, it does not fit the theme. So therefore, it's the same when it comes to trading. We don't believe that there is one number that fits all charts and all time frames. So we actually, when you're using the moveset natural moving average, we actually adjust the setting to fit the chart rather than the chart fitting the setting. Do you know what I mean? Right? I understand 50 and 200 is a very common number when you're using the moving average. I personally was using the 50 and 100, but the 50 and 100 does not work on all charts and it does not work on all time frames and all pairs. So the 50 smoothen 10 LWMA low price. Is this a okay? Is that a setting that you use, Henry? Right. So we've got different answers. So which one do we use? We have found that the best settings to use when it comes to moving average is to use the moving average that fits to the charts. Okay, so let me try to grab my pen. I actually tried to use a pen. I can't really find the pen. Okay, draw. I think this is it. Okay. Here. Oops. Just give me a sec. Let me just clear out draw. Okay. Can you guys see that this is what people usually use, right? People usually use the 50. When we look at the charts, the 50 looks like this, okay? The 50 looks like this, right? But you can see that there are times where price doesn't really touch the charts, okay? It doesn't really touch the charts, right? So a lot of times when we're using moving average, a lot of traders, okay, there's two very simple and known ways to use the moving average. One is when price breaks above the moving average, you enter for a buy, right? When it breaks below the moving average, you enter for a sell. Okay, that was one of the most common, the easiest thing the most common thing you hear about the moving average, right? Okay, the other way is to, when price comes back to that moving average, the moving average itself works as a form of support and resistance. Okay, the moving average itself works as a form of support and resistance. So every time price comes here, the trader will look to get in for a buy here, look to get in for a buy. When it comes here, look to get in for a buy. It goes up, it comes back, look to get in for a buy. Okay, so that is the other way to use the moving average. Give me a sec. Okay, that's the two ways. So dynamic and support resistance. Yes, correct. That's correct, said Henry. Okay, Karim is asking what's the best moving average to trade on, the 15 minutes or the 1 hour? Okay, when it comes to moving average or any kinds of technical analysis, again, I need to remind you guys that the best moving average that you should be using is the one that fits perfectly onto the the one that fits well on the chart and is effective on the chart. So I would say the moving average is effective on both the 15 minutes and the 1 hour, depending on the settings. Okay, it depends on the settings, right? It can work on all charts depending on the settings. Okay, so let me just erase everything. Let me just erase everything. Sorry, I need to just give me a sec. Okay. Okay, so this is the 50 and this is the 46, right? Can you guys tell me if you were to get in for the bounce, which charts would you prefer using? Just give me a while, Karim, I'll answer your question in a while. If you were using the strategy, right? If you were using the strategy where you wait for price to come back and you get in for a buy here. Every time price comes back and you get in for a buy here, which charts would you trust more, A or B? Would you trust chart A or chart B more? Okay, yeah, definitely the 46. But 46 is not a common number used for moving average, right? It's just a random number that we chose. Okay, I see someone saying B. Okay, actually why we choose A is because remember saying the moving average works as a support and resistance, right? So every time price comes back to that support, you expect to get in here for that buy. But can you see here? This is the exact same charts, okay? It is the exact same charts. It's just that the settings was tweaked. The settings for both moving average was changed a little. This one, whoops, let me go back. This one is the 50 and this one is the 46, okay? We manually went into the settings and changed it to the 46. Okay, we manually went to the settings and changed it to 46, and we can all agree that the A looks better when we're looking for entries. Okay, A looks better when we're looking for entries. Why? This is the exact same chart. If we were to use this chart, if we were to use B to get in for a buy, right? Think about it. If we were to use B to get in for the charts, B didn't even touch the moving average and we would have missed this buy entry here. Whereas here on the A charts, okay, whereas here on the A charts, price nicely touched the moving average and you enter here for the buy. Okay, so this chart is more accurate. We can safely conclude that the A chart is more accurate compared to the B chart. So whenever we are using technical analysis, to make our decision making, we need to take note, okay? We need to take note that our only job as traders or analysts is to try our best to find the most accurate information, okay? To try our best to find the most accurate as possible information. And there's no black and white written anyway to say that, oh, you must use it this way, you must use it this way. The best way to use something is whatever way that you find is effective, okay? So we have found that this is the most effective way to use it, okay? Okay, let's, let me just remove all the drawings, sorry. Okay, bonus, combining moving average with other strategies. Sorry, this is not the one we're supposed to identify reversals with the natural moving average, and that is exactly the strategy that is commonly used, which is to get in for the buy Whenever price comes to the moving average area, you get in for a buy. Whenever price gets into the moving average area, you get in for a buy, the support and resistance. Okay, so looks like we still have about 20 minutes. We can do the bonus, which is combining moving average with other strategies. Okay, so let's move on to the live charts, right? Let's move on to the live charts so that we can apply what we learned today. Okay, give me a sec. Let me exit. Let me share a new screen. Since we're doing a practice, we might as well try to find a setup. Can you guys, if you guys have any requests for any particular pair or instrument, do let me know in the chat box, right? If not, I'm just gonna randomly choose one. Okay, I'm just gonna randomly choose one. Let's do maybe sugar. Okay, that's a really, any Forex pairs? Sugar is a very uncommon. Okay, I think sugar is a future, it's usually a future chart, right? Okay, let's see how well, maybe let's do GBP NZD instead. Okay, let's do GBP NZD instead. Let's try to do a Forex pair. Because one thing about the sugar chart, we can do it, but because it depends on the chart you use as well, right? This chart particular, I wouldn't want to use this because there's a lot of gapping. It's probably because it is not a 24 hours chart. This chart is closed. Okay, let's try to do GBP and ZD. I see a request on BTC USD. Would love to do that. I am a crypto trader myself. Okay. Okay. One thing about the moving average that you guys might want to know is that the moving average works very well on trending markets. Okay, it works very well on trending markets. You can see here that market is kind of going sideways. There's a little bit of a triangle going on, right? There's a little bit of triangle going on, but it works better when it is ranging. Okay, it works better when it's ranging. Okay, so there's two strategies that I will be showing you guys. The first one is to use correlation. Okay, look at the charts that we chose. We chose GBP and ZD. Okay, we chose GBP and ZD as the chart. So can you guys let me know in the chat box, do you know what pair is closely related to GBP and ZD? What Forex pair is closely related to GBP and ZD? There is correlations with pair. It's the same with USD, the Canadian dollar, and oil. Why? Because Canada is a very big oil producing country, right? So the GBP is very closely related to, yes, thank you so much, Kurt. Yes, the GBP NZD is very closely to number one, the GBP AUD, because the AUD and the NZD is very correlated. Okay, for those who are not sure, you can just go currency correlation strength. Okay, just go to my FX book. My FX book is a good one. Okay. This is where you find correlation. Okay. Let's say you're looking for the GBP, EUR, actually the GBP NZD. Okay, the GBP NZD, when we compare it to the EUR NZD, EUR NZD, you can see that there is 89.6% correlation. It's very, very correlated, okay? Because the GBP is very related to the EUR and the AUD is very related to the NZD, okay? So one way we can use the moving average strategy is to use correlation, but then again, you can use correlation with a lot of things. How you do that, you see this plus button, right? You can plus, click on that, add the correlating pair, which is the GBP AUD. Okay, we're gonna add that in. This is not the one that I wanted. GBP AUD. Sorry, just give me a second. I'm trying to add in another chart. Okay, so you put it as new panel, new. Okay, and it will show below it, right? It will show below it. Just go into settings and change that into. Just change that to. I want to change this to a candlesticks pattern chart. Okay, these settings are tricky, but doesn't matter. You can see the price action going on here. Okay, now we're going to pull out the moving average. We're going to pull out a moving average. Why? Because this is our topic for today. So we'll be focusing on the moving average. Okay, on this, we'll be pulling out the moving average as well. Why isn't this coming off? Okay, guys, I think it's much better if I just open another screen. It'll be much faster if I just open another screen. Usually I can compare both charts. It's just somewhere in the settings that I don't see today. Okay, so one of it is GBP NZD and the other one is GBP AUD, right? Okay, we're gonna go into charts. I'm gonna get rid of this since it's not helping. And we're gonna see how correlated this pair is to each other. Okay, we're gonna see how correlated this pair is to each other. The more correlated it is, the more we want to use it. Okay. I'm gonna get rid of this. Okay, again, this chart was not the best to chart on anyways. Okay, we want to see what is happening on both charts. We want to see what's happening on both charts. So this is the GBP AUD and this is the GBP NZD. You can see that from here, price broke kind of like the moving average to the downside. So naturally you want to enter for a sell, right? Just using the moving average, you want to enter for a sell. But you can see from the past, every time it broke the downside, it was a fake out. It comes back and fakes out. It comes back and fakes out. So what can we safely conclude? It breaks here, it goes up, didn't really give you a good move, and it came back down, broke it. Okay, you would have been able to caught very small moves. What does this tell me when I'm looking at it? It tells me that the moving average doesn't work very well on GBP AUD on the 1 hour time frame. Okay, let's look at how it works on the GBP NZD. By right, price is supposed to break, go back. Every time it comes here, it's supposed to bounce off. It doesn't bounce off. It keeps breaking and keeps doing fake outs. It keeps doing fake outs, keep doing fake out. It means this is not an effective, moving average is not an effective indicator on the 1 hour on the GBP NZD and the GBP AUD at this current point of time. Okay, maybe in the future it'll work well, but at this current point of time, today, okay, today it does not work well. Okay, so let's quickly go and look at another pair, USD AUD maybe. Okay, and the USD NZD. Okay, I just want to quickly show you guys an example of correlation. Okay, the first thing I'm going to do is change this to the moving average, natural moving average. So how do you look for the natural moving average? What is the settings? I think someone was asking me earlier on, Karim was asking me, what is the setting? So we don't have a specific setting because again, we are adapting to the charts, right? We don't have a fixed setting, right? It's not 50, it's not 100, it's not 75, it's not 200. It is not a fixed setting. So the settings that we go for is usually using Fibonacci levels number. So the Fibonacci level, that is the 28, okay, 28.6, the 32, the 50%, the 61.8%, and the 78.6%. Okay, so these are some of the Fibonacci numbers. We try to use this number and we see how well it works. Okay, so let's say we move it to the 28%. Let's see how well it moves. Okay, do you guys think this is a good number to stick on? Okay, price came here, it broke out, did a fake out, came here. By right, when it comes here, it's supposed to bounce. Comes here, it's supposed to bounce. Okay, no, I don't think this is very good settings. So we need to adjust the settings again. We need to adjust the settings until we find a good setting that works well on our charts. So let's try the 32. 32 is not a good one. 50. Okay, I think 50 will not work. Let's try 61. Nope, doesn't work very nicely. You want to find a setting where price was respecting for a while, and that is the settings you're going to be using. Okay, let's try maybe 70. Okay, I think 70 is not the best. Okay, again, I'm just randomly choosing number because I'm trying to find a number that fits well. The thing about natural moving average, because there's no fixed number that you should be using, you kind of just need to experiment and tweak the settings yourself. Okay, why do I think 70 is a good settings for AUD at USD AUD at this current point of time? Because why? Okay, you can see price broke here, it came here, it reversed. It came here, it reversed. It came back to the resistance, it reversed. Okay, so just using these settings alone, we can safely say that price respected these settings. Okay, only on the first time it finally broke. Okay, it broke, it broke, it broke. It came here. Maybe the settings can be tweaked a little to make the moving average go under. Okay, but that will take a bit of time. We don't have a lot of time left. So let's say I've tweaked the settings to a better number and price was nicely respecting this moving average. Okay, maybe the correct settings would be like 72 or 75, whatever it is. Okay, it comes and reverse here. It breaks this, comes, respected this, turn back, broke, came here, respected this area, bounce, broke, respected this area, bounce, and then it stopped respecting. Okay, so my whole point of showing you this is that you need, when it comes to natural moving average, you need to find the setting that fits well to your charts. Yes, it will take a bit of time to find the correct settings, but you can just randomly jump and hopefully land on one that works. You can start with 10, 20, 30, 40, 50, 60, 70, 80, and see which one works well. So let me try 80 to see. See, the more I adjust, the more nicely it moves naturally. Okay, the more nicely you can see that price came here, reversed nicely. This part doesn't respect so nicely anymore, reversed, reversed, and here it breaks. Okay, so if this continues, if this moving average, this natural moving average is still working good, we expect price to do this, come back and retest nicely here, and then we can get in for a sell. Okay. So the other way, how we use correlation, right? The other way, maybe I can try 88 because that is a Fibonacci level. At 88 doesn't work well. Okay, maybe it's a 70. 70 was probably the, or 80 was probably the best as of now. Okay, now we go to NZD USD. You pull out the exact same settings, which is the 80, and see if that works well. Okay, let's get rid of everything else. trying to show you, okay, here price respected the 80. This part didn't respect, this part it respected, this part respected, it respected, didn't respect here, didn't respect here. Now it's not respecting. It just means 80 is not the correct settings for NZD, USD, NZD. Okay, that means we need to tweak it again until we find a better one. Okay, 100 is not the settings as well, maybe 120. Okay, 120 looks like a little bit better settings, right? It looks like a little bit better settings. We need to find the best settings for the charts. Why? Because we are using this to get our entry, right? You know what I mean? We are using this to get our entry. And how I'm using correlation. Okay, we only have 5 more minutes left, so I don't really have time to slowly look for the perfect moving average settings. Okay, it does take some time. Okay, let's say the moving average, I'm just going to draw a fake moving average. Okay, let's say you found the perfect settings, okay, and it's respecting price. Okay, so why I use correlation whenever, okay, let's say I found the settings and this is the moving average that I think fits best. Why? Because price came here, bounce, came here, reverse, came here, bounce, came here, bounce, came here, bounce, came here, bounce. So when price comes to my moving average again, I expect it to bounce again. Okay, so why am I using correlation? Because if I expect price to bounce, it means that I expect price to be a buy, right? My bias right now is a buy. Okay, the bias right now is a buy. Okay, so now what I do is I go back to my correlated pair, which is the AUSD, AUD. Oh, by the way, the thing that we usually use is actually the AUD, USD, and NZD, USD, but I already typed it, so it doesn't matter. Okay, let's say we have found a very nice moving average to use as well. Okay, and it looks something like this. It looks something like this, for example. Okay. Something like that. So when we're looking at the USD AUD, we are also biased that price is going to come here and bounce. Similarly to USD and ZD. So you're using the correlation on both the charts because, again, when you go to the correlation, you can see that they are, for example, 80+% correlated. They're 87.1% correlated. So the USD AUD and the USD NZD is a very correlated pair. So if your bias for one pair is a buy, the other pair should also be a buy. Okay, do you get what I mean? So that's how you combine correlation with moving average or any other indicator to confirm your bias. Okay, because you know, when I am trading, I think I have won half the battle once I have established the first question. So the first question I always have to ask myself, and I hope I get it right, is price moving in a downtrend or uptrend? Am I getting in for a buy or a sell? Okay. If you got the direction correct, I really think you would have won half the battle already. Imagine you think it's a sell, but actually it's a buy. It's a very, very long buy. So using correlation and moving averages, you are able to confirm, the direction that you want to get in on. Are you getting in on a buy or are you getting in on a sell? Okay, that's one. The second strategy that I'm going to show you guys. So the first one is correlation. The second strategy I am going to show you guys is the usual strategy that I use on a daily basis. One is to combine, right? Combine the moving average with support resistance, Fibonacci levels, the moving average, other indicators, and chart patterns. Okay, so the first thing I'm going to do is look for trend direction. I do see price moving on an uptrend. If anyone else sees anything else, do let me know. I only see price moving on an uptrend. In fact, it is moving in an ascending channel. Okay, it is moving in an ascending channel. Okay, now I am going to highlight some support and resistance. Okay, there is support and resistance here, right? There's support and resistance here. Okay, so right now looking at the channel, I am biased that price is going up. Okay, I'm biased that price is going to go up. Why? Because there is bullish momentum. 2, I think price is going to go up here. Why? Because there is a horizontal pullback level here. Okay, 3, why do I think price is going to go up from there? Because when I pulled out the Fibonacci, right, there was the 61.8 lining up on my support, okay, which is giving strength to my support. Okay, that's 3, why I think price is going to go up from here. 4, why I think price is going to go up is because when I pulled out the moving average indicator and I used the natural moving average and I adjusted the settings, okay, guys, again, we don't have time to find the exact settings for these charts. That is just, you have to toggle with it, right? When I pulled the moving average indicator, there was a moving average here. So I expect price to move down here and bounce here. So the other strategy that I'm trying to show you guys is to combine the moving average with other technical indicators to get an even more accurate analysis. It's the same concept as the pink dress that you wanted to buy. You want to buy a pink dress, you don't know if it's good or not. So you ask your mom. Okay, your mom says yes, your dad says yes, it looks good on you. You ask your grandmother, everyone says it looks good on you. There's only one guy who says it doesn't look, it's your brother. Your brother says it doesn't look good on you. But you're thinking, so many people told me it looks good. I don't care what my brother thinks. I'm gonna get the dress anyways, okay? So right now we've got so many things telling us that this is a buy, right? You are going to get into this buy because there's enough reason to believe that price is going to bounce from here. Okay, so you use moving average with everything else, combining with everything else to get an even more accurate analysis. Okay, one thing you need to remember, you need to drill it very hard into your brain, deep into your brain, is that your only job as a trader is to find the probability of whether a trade will work or not. Okay, you want to get in here for a sell. You are now going to use technical analysis, fundamental analysis, whatever it is analysis you have, maybe your gut feeling, maybe whatever it is, whatever you can use to find how probable is price going to come here and reverse from here. Okay, using technical analysis, you will be able to narrow down or give yourself a rough percentage of whether a price is going to work. Because let's say you have established that an analysis is, oh, there's an 80% chance that this is going to be a buy. That means you get in, right? But you see, it's totally different. I think a lot of laymen have a conception that trading is gambling. It is not gambling. It is calculated, collected data and risk management. Okay, the difference with gambling and trading is based on very high probability. Okay, whereas gambling, for instance, you go into the casino, you play blackjack, it's a 50-50. It is a 50-50. Okay, you play roulette, it is a 48% chance of winning. Playing blackjack is a 50% chance of winning. Playing the slot machines is a, I don't know how many percent, maybe 3% chance of winning. Playing, I don't know what other games there is in the casino. I can't even think anything, okay? The probability is against you. Why? Because the probability is so low, chances of you losing to the casino is higher. The casino always has the upper hand to win you. But when it comes to trading and the charts, you get to use technical analysis and all these tools to narrow down how probable a trade is. If it's probable, get in for a trade. If it's not probable, don't get in for a trade. Save the money and don't get in for a trade. Okay? So that's all. Yes, I would agree. I really love poker. I think poker is a game of skills, right? I would agree. Trading is kind of like poker, right? I would have to say poker also has a lot of luck involved in it, right? But trading is maybe a lot more skills and research. Okay, so that's all I have for you guys today. I will catch you guys again. Thank you so much. I'm glad you enjoyed this class. I'll catch you guys again next week. Thanks for attending. Take care, everyone. Hope you learned something. Yes, more importantly, hope you learned something. That's the most important thing here. Hope you guys eventually will be able to grow your accounts into millions and millions. Okay, so I'll catch you guys again. Bye, guys. Thank you so much. Are you or Desmond taking the trading tomorrow? It should be Desmond. It should be Desmond. Tomorrow is live trading analysis, right? Tomorrow is the live charts, right? It should be Desmond, right? Because I will have another webinar to take, right? But if you guys wanted me to take it, you guys can just write in to IronFX and tell them, just write in, maybe drop an email, say that you prefer me, or it doesn't matter, because me and Des, we can swap any day. It doesn't matter, it's just what you guys prefer, because ultimately, again, we are doing these webinars for you guys so that you guys can learn better. Okay, so thanks guys. I will see you guys again soon. Okay, bye.